Welcome back. Here with us on Trading Hour. As promised, let's get you that perspective from HDFC Institutional Equities on the market, the way ahead now that we're done with the third quarter earnings season. We have Unmesh Sharma, the head of Institutional Equities at HDFC Securities, with us for the chat. Unmesh, good to have you on the show as always. I was quickly going through the third quarter note that you folks had released, and it seemed, as sort of a surface glance, that you folks are expecting the earnings, positive surprises to perhaps slow down as we move to the last quarter and then into next year, and maybe some of the comfort of lower input prices to also start wearing off. Just tell us, what's the stance on the market now at 22,000 plus?
Yeah, so, I'll split that up into two parts. One is what is the market view? But before that, specific question on the earnings. One very interesting data point which our team has picked up is that in this quarter, only 38%, roughly a third of the companies have actually surprised positively. So if you look at the way in which the earnings is, playing out, is that while our earnings estimate for 25 and 26 have gone up by around 1%, the number of companies which are contributing to that has reduced. And you can see that this has been consistent. So Q4 last year was 61%, then 51, 44, and now 38. So in a sense, what started to happen is that the headwinds, as far as earnings are concerned, in terms of where you can get positive surprise, has started to come off. And you can see that actually, to a large extent, the heavy lifting was done by only 5 or 6 stocks. I think between Tata Motors, ICICI Bank, IOCL, so on, the top 5 companies have contributed to 61% of the total earnings growth. So to a large extent, what we are saying is that, which is very consistent with our overall call in the market, which is a bit cautious, is the fact that at the headline level, if you look at Nifty is trading at over 20 times on FY25, which is well over 1 standard deviation above, which gives us a little bit less comfort on valuations. On top of that, the earnings surprises have got narrowed down to a few stocks. So it's going to be a very, very stock-specific kind of environment. On the overall index level, we have fairly limited comfort as far as where the Nifty returns will be. We expect that to be in single digits.
Unmesh, one of your preferred sectors is power, as you have highlighted in the note. But considering how the power PSUs have moved up over the last 12 months, do you still see more upside in these power names?
So, interestingly, if you look at our power sector weights, we basically have, NTPC, which is a slight overweight, which is like, you could call it a defensive move. Okay. What also we have added in this latest round of is the InvIT from PGCIL. Now, the reason for that is also a combination of our view on the market. Which is, adding an InvIT is a defensive move, to be honest. And we put a 2% weight on that. So if you look at the overall overweight of 3% or thereabouts on the, overweight on the power, actually 2% of that actually comes from the InvIT. So it's more defensive than anything. The only alpha position we have there is CESC in our model portfolio.
Unmesh, where are you on the great banking debate now? Because there's one view that says that don't expect any great fireworks in terms of earnings, whether it's margins, etc. There's another view that says that you still have valuation comfort over here. I mean, when we complain about the rest of the market, pricing and everything to perfection. So then what does one do with this non-starter of the sector, big banks?
Yeah, though this one has been a difficult one, because if you look at relative sense from an index perspective, really, there is fair bit of valuation comfort on the large banks. But at the same point in time, we currently, in our latest round, have cut our, model portfolio weight. And now it's around 31%, used to be 33, ballpark, right? We still continue to hold the large banks. However, there is one thing that we need to note is that one, the way in which we are playing financials as a basket is looking at the large banks. We are not comfortable with the small banks. In fact, we have exited the position in Bandhan, which we used to have, for example. What we have instead done is gone bottom up. For example, we have a 150 basis point weight on Federal, for example. And then we fill up the rest by going outside the lending financials into the structural themes such as insurance and the capital markets companies. We have reintroduced weight, for example, on BSE, which is more market infrastructure. So that's how we are playing it. In the short term, the fact that the deposit growth has not come, there is a systemic liquidity issue, is something that is giving us lack of comfort for maybe a couple of quarters. But in a portfolio which is as defensive as ours, staying long large banks continues to remain the call.
Right, Unmesh. We'll leave it at that. Thank you so much for joining in due to paucity of time, but we'll connect again more on the markets and on specific stocks. That was Unmesh Sharma there of HDFC Securities. Time for a short break. More on the markets on the other side. We'll be right back.